do you think it could be, systemic? Right? Do you think there's a systemic risk there?
I think, well, first, let's break down a few things. How do I even get into this? You're right in that, on the investor side, you're looking for a way to protect that premium with that floating rate structure, as you mentioned. You're looking for the upside, getting exposure into private credit because it's a buzzword. It's blown up in the past couple of years, as you mentioned. And so, another thing. Sorry, quoting the Howard Marks the Memo podcast again. It's just, you have innovators and the smartest people get in first. Is essentially what I'm saying. And so, by the time that retail investors get in, typically, some of these stocks, assets, securities in general are overpriced, or they've already priced in a premium because it's because there's already so much demand for it, right? And it's important to remember that a lot of these firms participating in the private credit market today are these are funds that are taking AUM fees, and you have to question the level of underwriting that they're able to accept.
Sure.
With all the money, with all the demand that they have to get inside this industry, right? And so, circling back to the original question, like, is this systemic, right?
Yeah.
And so, essentially, I think the best way that it's been said is that it's not. To quote Mark Twain, right? Okay. History does not repeat itself, but it rhymes, right? But it sure does rhyme, or something like that, right? And when people talk about the GFC and the similarities to what we're seeing in the market today,
well, that's what they're comparing it to.
No, exactly.
That's what they're going after. They're going after the GFC aspect.
It's interesting because I don't think that we'll see maybe as bad of a correction, but I definitely do think that something is that there could be a slight hiccup.
Yeah.
But with that being said, it comes down to who's really exposed to it.
Sure.
How many, like what really captures the exposure, and that's going to take a lot more research, right? But on top of that, just I don't think that the private credit hiccup, say we'll get rid of the industry at large. I think that it'll innovate, and if anything, it'll be for the better. So.
No, 1,000%.
Yeah.
No, and I think that's well said. I think the innovation aspect, even if we do this sort of correction within the private credit industry, which seems like we will, at the end of the day, there's always an innovation, right? Like the innovation from the GFC was from the bank lending side was private credit.
Exactly.
Right. Like
you have like the shadow banks kind of evolving into private credit, and you have direct lending.
It's crazy because you have this area where, again, it's not regulated as much as banks and credit unions would be on the lending aspect. And so if it's not as regulated, then obviously there's an aspect there that people or borrowers can go and look at, the debt funds, and the debt funds see this as an opportunity for flexibility. They can operate under different regulations, under different rules, and they're not monitored as closely, right? Like there's, again, this, this sort of Basel III. So the Basel Accords essentially came out over like a long period of time, but Basel III came out because of 2007, 2008. It added all these extra, requirements for essentially lending institutions to abide by. And so I think that's really, what sparked this sort of direct lending private credit aspect outside of the banks. But I got some statistics here that I think are really interesting. So the IMF, looking into the systemic aspect, IMF said in 2025, their financial stability report, they found that 40% of private credit borrowers have negative free cash flow. So up to 25%, up from 25% as well the year before. And then in addition to that, the BIS quarterly reports finds on March 16th that private credit lending to SaaS firms increased from 8 billion to over 500 billion. So I think during this exact same period of time, you see that 40% of private credit borrowers have negative free cash flow. And in addition to that, private credit lending to SaaS firms has increased from 8 billion to 500 billion in 10 years. So, and I'm not saying there's necessarily this direct correlation or direct causation, but I definitely think there could be a correlation there as well. essentially if these software companies, like you were saying before, you're looking at it from the perspective of, okay, they're going to be making a lot of money later. Essentially the growth aspect behind SaaS. So again, the capital intensive nature of, the AI, we could say AI infrastructure as well. Again, private credit banking on the potentiality aspect rather than just the, the aspect behind, okay, is earnings actually materializing, right? JP Morgan found an estimated total AI company issued debt at 1.2 trillion for public and private debt. But obviously we're seeing this growth, right? And it seems to be from the AI perspective, and it seems to be massively attributable to, private credit. I mean, an exuberant amount of money is going into this. And then in terms of, AI build outs, right, we see 28 to 36% annual growth in that. And it's probably even more.
Yeah.
That was according to S&P. So bulk of this is fueled by large scale AI superclusters and globally distributed inference capacity. That was a rough one, but basically that means, essentially to run processing closer to data sources. So what this means is like you reduce the delay, but you increase the actual output of data.
Yeah.
And so, the AI superclusters and the inference capacities are essentially fueling this AI build out. And you're seeing this on like the hyperscaler level, right? With Microsoft, you're seeing this with, various different large blue chip stocks, that are also doing that. So, but again, they're taking out, a lot of money in at such a high interest rate that private credit does usually, essentially offer. So I think the aspect of it being systemic, right? It seems to be contained within the SaaS AI software industry, if from that perspective. But again, if you have now potentially retail investors putting this in their 401ks, you see, institutional investors again growing their diversification, their portfolio to this. I think, thankfully now there's this sort of skepticism, which may put a little bit of a halt and kind of say, hey, maybe we're going into an area that we don't need to go into from the investor perspective. But the thing is there's an infinite amount of borrowing on that side. So I think the concern would be if borrowing increases technically, theoretically infinitely with regards to the AI push out, then from the investor side, where are they getting the capital from, for the borrowers? So it seems like the investor side needs to happen. So
for sure.
What has to happen is some sort of higher regulation, tighter rate. Because if you want to go and understand, like you could go and look at the delinquency rates of private credit. There's core delinquency rates, which, estimates around like 5 to 6%.
Yeah.
But then there's actual estimates that seem to be a little bit higher than that. And it's such a shadow banking industry. So how is it that we can, sort of find like any sort of reliable data? I think right on this, I mean, it just seems so difficult.
Data is the number one bottleneck. I think, when you're as a retail investor or an institutional investor or whatever you might be, I think at the end of the day, it comes down to you're making decisions based off of the data that you have, right? Yeah. And so with stocks, it's easy because you have their 10Ks or their 10Qs, and you can tune into their quarterly reports or their annual reports, or I guess since they're gonna get rid of the quarterly reports, sure. But you can tune into these reports, and you, as a shareholder, you have access to data because it's readily available to you. Yeah. And whether it's real estate or private credit, I think those are the two industries right now that it's not that these firms are doing. Let me really walk myself through how I phrase this, right? Yeah. It's not that, real estate or private credit is doing really good or really bad or lags, in comparison to the market. It's just that the data that we see from real estate or private credit or even private equity isn't regulated. Like you can't see that, you can't see pricing changes on a regular day-to-day basis. Yeah. Right. And so in terms of managing and overseeing your investment as an institution or a retail investor, there's not much that you can do there, right?
Yeah.
Unless you're talking to the asset manager or the asset manager yourself. It's like that's a completely different story.
Sure.
But in terms of what we can do, it goes back to different economic principles, right? Like actually, to kind of relate this to something else in Europe, this next generation of European cigarette smokers is going to be, or is this next generation of European cigarette smokers is going to be the last one that there ever is.
Really?
Right? I think this current generation is going to be the last, something like that, right? And I'll kind of run you through the history. Right?
No, I'm curious about the logic.
The logic, and here I'll explain the parallel as well, right?
Yeah.
So the question, or not the question. So here's the context: the law, or the whatever's in place now, right? This next generation, if you're born past, let's just say, because I don't know the exact number, if you're born on 2026 and up, the cigarette smoking age requirement goes up every year by 1 forever, right?
Really?
That's to my understanding. That's how I, that's what I read, or that's what I heard.
Oh,
right?
okay.
And so essentially they're saying, like, this is like me and you, if we went to Europe, we could go get cigarettes, not that you would, but it's just,
right. No, I get you.
But this next generation won't be. And so the question that rises from a regulation like that, right, is what's going to happen to the shadow industry of cigarettes, right? Because now you have, in different countries, I can go to the United States of America, and when I'm 21, I can go buy a cigarette. Not to say that, anybody's really fiending for a cigarette, but, but it comes back to, well, this used to be allowed, and this used to be unregulated. This used to be something that I could do, and I can't do it anymore.
Sure.
It doesn't mean that I can't get it anymore, but it means that I'm gonna have to go through a darker alleyway,
right? A different process to get it.
Right. And so
interesting.
When you ask about regulation, I feel like that's always economists and politicians' like number one question. It's just like, what's really being incentivized here, right? I'm sure you've sat in economic classes or econ classes. And you hear the downsides and upsides of like rent ceilings or rent floors,
of course,
right?
of course.
And so when you can't get to that equilibrium, and when the government, or really being careful.
No, you're good.
But when you get that increased regulation, right, the market's not able to perform at that maximized point.
Yeah,
right?
sure.
And so when you're talking about regulation and private credit, I think more than you're going to be regulated to keep this amount, or do this, similar to how banks have to keep like their interest reserve, right? Or they're not their interest reserve, but they have to keep reserves so that
I get what you're saying. They have to have a certain reserve requirement.
Exactly.
Right?
Yeah.
Lend out.
As opposed to that, I think it'll be it could have a similar structure to banking, or it could just be a more regulated way of reporting.
Sure.
Right. And I think, with real estate or private credit as a whole, I think that could be extremely beneficial to the rest of the market. Especially when you're factoring in, for people's 401ks, like this is their livelihoods.
Yeah. Yeah.
It's insane.
And people need their 401ks, man.
Oh, absolutely.
I think it's insane how much, the 401k balances have changed by generation.
For sure.
Absolutely insane. Looking at that over a long period of time. But no, I think you made a really good point, right? Like the shadow regulations, and you could look at this with cigarettes. You could, even vices. You could look at this with like liquor too, right?
Yeah.
Prohibition era.
Exactly.
Yeah, 1,000%. You see an area that's heavily regulated, yet it's still being used.
Yeah.
And it's
and
now part
Al
of
Capone,
right. You have a massive criminal enterprise that's then created after that. I think it's fun. It's just one of those areas that's fundamentally like, I mean, like you have a teenage kid that wants to go and like, smoke or do whatever, and he wants to go and enjoy his life, and enjoy his life. I think, he wants to go.
In hindsight,
yeah,
probably not,
but he wants to go and do, and it feels better when. Right, because you're a rebellion. It's just oh my god. There's a different sort of emotion that comes along with the fact that you can't do it. Right,
exactly.
It's like it's a bad thing to do.